Yo, what's going on, guys? Today I want to take you through one of my favorite dividend stocks of all time that I actually own, so I might be a little biased, but we're going to be going through their investor presentation because it is super impressive. I'm going to give you an overview of the self-storage industry, and this is a real estate investment trust or a REIT, which means if you're someone that likes high dividend income and dividend growth, this is like the perfect stock for you. Hashtag not financial advice, not personalized advice, but I feel this is the perfect stock that SCHD should add into their portfolio, and I'll show you why. It's because of this. So if this is what you're into, don't forget to drop a like on the video. It really helped me out a lot. But let me give you a quick introduction to CubeSmart. So they have about 1,500 properties, and they're triple B rated from S&P Global and Moody's. So there's a lot of safety in being rated from S&P Global and Moody's. Those are two also publicly traded companies you can invest in. But let me now tell you about the attractive industry that self-storage is. So they have really high margins, so very low expenses. It's literally four walls and a sheet metal door, and low capex requirements. And this is what I love about self-storage, and they did this very successfully. It's short-term leases, which means they are month-to-month leased. And that allows for rapid repricing in response to changing economic conditions. So what that means in a nutshell is if inflation comes back, they can raise the prices instantly in the next month. Some of these other REITs have long-term leases where they have to wait a long time before they can, hike prices to keep up with inflation. Well, self-storage is month-to-month leased. They can instantly capture the inflation. And here's the self-storage average return versus RMZ. RMZ is very similar to VNQ. And I just decided to pull up VNQ because no one looks at the RMZ index. Whoa, I don't know what's going on with the chart, but no matter what chart you look at, CubeSmart has always outperformed or the self-storage industry, and you can kind of see that here. We'll keep going. Cash flow stability, they're in 41 states and the District of Columbia. Look at these properties. These are pretty cool looking. 755,000 customers, while no single tenant represents a marginal segment of the rent roll. So that's really good. And this is their diversified portfolio. This is pretty cool. So all the states that are in red are ones where they actually own the stores, own the land and everything. But the gray stores is the states with managed stores only. And here's what's cool about that. They let them use their CubeSmart name and everything, but every single year, CubeSmart receives this annual fee management income that's all margin. And we'll go into that a little later. I'll show you how much they're making off that. So I like that they're doing these managed store properties. So let's keep going here. This is the most important slide. And more importantly, right here, the average 3-mile population density. It is look at the huge gap difference between their two biggest competitors. They're at 100. They're at over 100. This is a 50% more average 3-mile population density. This is what stands CubeSmart out, and that's what I love about them. And they also have the average 3-mile household income. So because of this right here, they experience less volatility. They're not in the middle of nowhere, kind of like National Storage Affiliates, which I like all the self-storage stocks, but that's why the actual one that I own is CubeSmart. I love this property. And check this out. This is what's really cool. They're the market leader in New York City by far. Look at this. Out of their whole entire portfolio, 5.3 comes from Bronx, and then another 5 Brooklyn, Queens, other New York. So all this is 15% of the portfolio already just there. And then basically, Long Island adds another couple percent. So they're very concentrated in what I think is the best market. Class A properties that look at this property right here. They create vibrant billboards for our brand. Like if I drove past this, I'd be looking at that. That is a very nice looking store. So here is why I love that CubeSmart is in New York. They're publicly traded. They probably have friends there in New York who did this. So legislative changes removing self-storage properties from the ICAP tax incentive program. This happened in 2021, 2022, and basically all the self-storage properties that were in the program stay in the program and get the tax incentives. But if you go out of your way right now and just want to build a new self-storage property, you don't get these tax incentives anymore. So that means the competition in New York isn't coming. So they just keep dominating the market, and they've already owned the entire market. So that's why I love CubeSmart right there. And here is their portfolio growth. So here in 2010, they had 460 properties. Just look in the past year. Now in 2024, or year to date so far, they have 1,473. And if you look right here, they have a huge bump up in the managed stores, which we'll scroll down later. I can't wait to show you how much annual fee income that's all pure high margin they get from these managing stores. It's actually not that, it's not crazy, but it's pure margin for the company. I'll just go ahead and show you that right now. If we scroll down here, oh yeah, so 3.1 billion of wholly owned acquisitions. So that's this right here. These dark gray bar is the wholly owned stores. I like that it keeps going up. Most of these wholly owned stores, are all the ones in New York. They own the most important ones. They don't manage the ones in New York. The most important ones they wholly own. And if we scroll down here, we can see, of course, 1.6 billion of third-party management acquisitions. So, and 83% of the acquisitions in the top 25 MSA, which is basically the markets you want to be in. And here is the joint venture advantages. So 900 million properties acquired in joint ventures, 75 total properties, and these 75 total properties brings them $37 million in yearly income. I know it's not that much, but it's growing and it's pure margin for the company. Do your own research. Everything I could say in this video is wrong. They like to suit up the investor presentations. It's a lot of common thing to do, but 600 million of new projects delivered, and 100% of those are in the top 10 markets. 94 million of new projects down in the pipeline, which is pretty cool. But yeah, that's really what I wanted to show you about the self-storage industry. Oh yeah, we got to go over their financial strength. So this is the net debt to EBITDA. Of course, they're rated from Moody's, S&P Global, triple B, which is awesome, stable. And this is their net debt to EBITDA ratio. So I went and looked at Realty Income's. They are at a 6.5. It's not a perfect comparison because they're a triple net lease REIT, but 4.1 is very, very fair, and it's not for 2024 yet. So this is as of December 2023. So it could be a little bit different. And the debt to gross assets is at 38%, which is pretty good. And it's at unsecured debt, which means you have to be a pretty quality company to get unsecured debt, which means there's no collateral or anything. And we can see all the debt maturity schedule. It's very healthy, and they have proven ability to access a variety of different sources of capital. So they've raised equity through all of these different kinds of things, through preferred equity, bank debt, credit facility, unsecured senior notes, common equity. They've done it all, and they've proven that. That's why they're triple B rated from S&P Global and Moody's. They've been in the self-storage industry for 19 years, and 18 years of that publicly traded. So pretty awesome. And here, let's see what this is. Efficient expense management growth. Oh yeah, okay, I remember this slide. So check this out. This is the peer average. This is the expense growth. So how much more they're needing to spend. And CubeSmart has been the lowest. They haven't need to spend that much more compared to their competitors, especially in 2023. CubeSmart's only at 1.5% expense growth. And here is the funds from operations growth. This is the number we really want to look at. We don't look at net income because this number right here, the FFO, adds back the depreciation and the amortization, which net income does not do. So this is the number we want to look at, and we can see it just steadily grows. This is very good for a dividend stock, and this is adjusted per share, so this includes stock-based comp or any kind of acquisitions they do. Oh yeah, they're sharing cash flow growth, consistent history of dividend raises. So this is awesome. Look at the annual dividend. In 2013, it was 50 cents, or in 2020, it was just over $1. And it has grown tremendously since then. So that's why I'm saying this is a dividend grower. So they'll slowly grow their dividend over time and generating outperformance. Okay, so this one might be a little cherry pick the dates here because it's not a crazy amount different. And the two competitors are Public Storage and Extra Space Storage. So actually, that is the two biggest competitors. So it's good that they just included those two. And this is as of December 31st. So we won't look too much on that. Oh yeah, environmental highlights. This is kind of the end of the slides here, but they added solar panels to 98 stores, free energy, HVAC upgrades, environmental targets. So they're really focused on social highlights, ESG. Oh yeah, check this out. Supporting corporate governance. They have anti-hedging practices, separate board and shares. So 89% of it is independent, which is really great. Shareholder rights, all that kind of stuff. Okay. This is another really important slide. This is the very last slide. So last slide we'll look at here. Then I'm going to hop into my Moo portfolio and show you how we're doing on our CubeSmart position. But this is the same store rentals, so it's actually up from last year. So look at this. They're making more rentals in May than they were last year. And check this out. This is the same store vacancies. They stayed flat, completely flat since the previous year. So other ones, we can see their actual same store occupancy rates. So from last year, we are actually down 100 basis points. So the occupancy is a little lower, but that still doesn't change the fact that they're still cranking out money. Oh yeah, down here, expense growth 5%. So this is the reality. You know, revenue growth is 0%, expense growth has grown, but the company still just generates so much money. Their dividend is super safe. They can easily afford to raise it. So that's kind of why I love CubeSmart, but there are some risks. So yeah, right now our Moo portfolio is worth $6,300. We are all-time down $350, and we can thank Perion Network for that. We're down over $1,000 on that stock. But CubeSmart, you know, it is 18.91% of the portfolio. We're up 17% on them on top of the dividends I've received. So I've owned CubeSmart since October of 2023, so about half a year. And so you can add about a 3%. So I've got a 20% total return from CubeSmart, which is amazing. And as you know, once I buy a stock in here, I will literally never sell it for the rest of my life. So if you come back to my channel in a long time, I will still own all of those stocks. And let me show you also my Robinhood portfolio. Since we're sharing the portfolio here, you know, tell me what you would change about my portfolio. So yeah, thank you guys so much for watching. If you would, please drop a like on the video. Hope I introduced you to a new dividend stock you can add to your watch list. I'm not saying buy or sell it. You know, I can't do that, not personalized advice. But yeah, hope you guys have a great rest of your day.